funny. Someone's like, oh, this bank crashed and I owe him money. Now I'm debt free. And it's like, no, there's when Two Fingers Tony goes down, there's a guy next to him coming up to buy that book of business, and that's the way it goes.
Welcome to Multifamily Insights. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. If you haven't done so, make sure you hit that subscribe button so you don't miss an episode. If you're enjoying what you're hearing, leave us a rating and review. We'd love to hear from you, understand what's working well for you and your investing goals, and also anything we can do to make it work harder for you. So let us know that. Leave us a rating and review. We'd love to hear that. Today, we've got a great episode. This is going to be another special one because this is a conversation I had live with Sam Sharp from Guaranteed Rate a little more than a week and a half ago. And Sam is coming to us to talk about really how the current lending environment is shifting, or more specifically, how the impact of Silicon Valley Bank and their collapse may impact you as a real estate investor. So we're going to get into my conversation with Sam, and then I'm going to come back with some updated information with some things that we've seen and some other things for you to keep in mind as a real estate investor who is looking to put your capital to work moving forward in 2023. Before I get into that, I just want to let you know that, Sam is coming to us as one of our partners for the Midwest Real Estate Networking Summit, and tickets are still available for that event. Make sure you go into the website there. You can use our promo code podcast and save on your ticket there. So go to midwestresummit.com, and then make sure you stay tuned after the interview with Sam. And I'm going to give you some more information regarding how you may be impacted with some of the bank collapse, not just Silicon Valley Bank. We obviously have seen multiple banks now impacted due to multiple factors. So we're going to talk about that a little bit more after our interview with Sam Sharp. Hey, what's going on, everybody? My name is John Kasman, and I am excited to have this conversation today. I am the founder of Kasman Capital Group and also the co-founder of the Midwest Real Estate Networking Summit. We're excited for this year's event. We've got that coming up May 6th and 7th in Chicago, and tickets are on sale right now. If you want to get your pre-sale tickets, they actually go up in price after tomorrow, so it's a great time to get it. But this conversation is going to be a great one. Obviously, the last week has been rocked in the financial world by the collapse of Silicon Valley Bank. And we're going to bring on Guaranteed Rates Sam Sharp to talk about how this could impact real estate investors. So without any further ado, let's welcome Sam Sharp.
Hello, hey John, how
Sam.
you doing?
I'm great, man. I'm great. How are you doing today?
I'm doing good. Nice to see you. Very excited for May 6th and 7th for the big event. Nice to see it back around and coming out full force.
Yeah, man, been a couple years since we had a chance to do this live and in person. So excited to get back to that. We've had over 300 attendees the last time we did it, and you're going to be there, and Guaranteed Rate, and not myself, my partner Bree Schmidt. We got Jay Papasan from The One Thing, and a host of other speakers. So really excited about that. But Sam, today I really want to just talk about what's current, right? I mean, this Silicon Valley Bank situation has made a lot of people think twice about kind of their relationship with their lender, their relationship with their bank, the way they make their deposits, and really just the overall impact. I guess, for those folks who really don't understand exactly what happened, could you give us a high level recap, and then talk to us about, the impact it may have with real estate investors?
Yeah, happy to help. Yeah, interesting as we've seen this unfold. But to simplify it, basically, that so given the situation, the SVB followed a pattern that is traditional in the banking industry, right? They took in a large amount of assets. They have to take those assets and put them in a safe place. Treasuries have, banks have historically placed money into treasuries for a safe haven, which, if you don't have to become liquid in a very short period of time, can be a better bet. Now, I've heard a lot of people say, well, they didn't do anything wrong. They followed the playbook. And you could say that, although it could be argued that they didn't do anything wrong if they thought interest rates were never going to go up, and that some people might actually start to pull back. And that's realistically what happened, right? So they bought treasuries. A lot of attention got called towards where they were putting their money, how quickly they were growing. And then there's really one main investor who started spreading the word about there's a problem and you should get your money. It's like a run on the bank, right? And people ask for their money back. They're not liquid. They say, okay, how are we going to get the money back? We're invested in these long-term treasuries, which had this taken 3 years, when these were mature, then it wouldn't have been as much of a disaster. But Now, when you have to sell them short at a loss, how are you going to sell in the open market? How are you going to sell someone, something that's going to pay 1 to 2% when the going market rate pays 5? So it creates a big position, and then now all of a sudden everyone else is starting to panic, and that's human nature, right? So we start looking at the way that you start looking at a position where everyone's starting to question their banking practices, where their money's at, and their safety. And I get it, and rightfully so. With the reality being that had there not been a demand for that liquidity, there would not have been an issue, right? It wouldn't have been. It wasn't a performance issue, kind of. Without saying that, I don't want to get into the details because actually there was obviously some issues, but and there's a lot of other banks that have followed these same practices that will fall prey to the same situation. So we're going to see more of this coming up. Now, what going through and looking at this, when you were talking about how this impacts real estate investors, liquidity, right? When we're in a position where you've got two things that are going on right now. So banks take deposits and they lend money, right? That's the model. Give me your money. I'm going to give it to someone else and make money off, and I'm going to keep your money safe. If the first problem we run into that we've started to recognize in the industry is that if banks are not taking in deposits, then they have a lending issue, right? And now, if people are taking their money out, now you have, again, a liquidity issue. So for investors, this could pose a problem as far as what's available for the funding on looking to make the moves. Now, that's going to carry across a couple different streams, right? You have residential, commercial, different types of lending. You'll see a lot of people right now talking about some of the benefits of this, if you will, in the residential side of things, which for investors could still mean 2 to 4 units, right? So still investment properties and for investors, but because what this has done now is called the Federal Reserve, it's called light to the Federal Reserve's policy and how quickly they've hiked interest rates and saying, okay, well, everyone had their money here, now you put it up here and you created a problem, right? Which I'm just going to put it out there real quick. Like, no one saw that, right? I saw that, and the people that are running the show, so to speak, in these different areas are much smarter than I am. So it's interesting to see how that's played out. But without going down that road, looking at this, what you see then is we're going to find that now the Feds are talking about pausing the interest rate hike, and then interest rates dropping, which has got a lot of people in the real estate industry. Well, they're happy. Whether they're excited or not, I don't know, right? But it puts you in a position where interest rates start to come down and we start to see that spike some activity. On the investor side, though, there's still a lot of hesitation in the secondary market through Fannie Mae and Freddie Mac for investment loans. They've become very expensive, because there is that flight when you're dealing with the situation of what we came through the pandemic and through uncertainty. You uncertain times create this risk aversion, right? And banks look at this and say, if push comes to shove, if it comes down to it, basically you're going to keep your house rather than your investment. So they make it more expensive. A lot of times banks don't like to say we don't do things. Instead, we just say we just make it expensive so you don't want it, right? So I'll be curious to see how this plays out through Fannie Mae and Freddie Mac, because there is still that corresponds now with still a tremendous focus on affordable housing and how to try and create that, which is beneficial for the multi-unit space. And I can get further into that, but I know we got a short period of time.
Yeah, I mean, I think there are a couple things, right? So you talked about, first of all, one of the impacts that investors can see is the potential for interest rates to come back down, and seeing them flatten out. Maybe they're not going to do the rate hikes that were planned previously, and maybe you will see interest rates start to tamper off a little bit and come down, and that could be opportunity for real estate investors. On the flip side of that, Fannie Mae, Freddie Mac, they're still very hesitant in the lending space for investment properties are concerned, and they may want to continue to provide terms that are less than favorable to really shy away from encouraging investors to continue to be aggressive in the current market. One of the things that I know I was reading about was just understanding kind of where you are with your loan, the loan covenants, some of the details in it. I imagine many investors, or most investors, don't understand kind of the financial situation of their lender. We go to a bank, they're there, we see the building, You assume that you put your money in there, it's FDIC insured, you're going to be able to get your money back. And then this bank run really made people wonder how secure their capital actually was, particularly some of these smaller banks. As an investor, when you have a loan with, a lender, and not necessarily SVB, but especially these regional banks or these other lenders, are there specific things we should be paying attention to, questions we should ask, or any moves we may want to anticipate to protect ourselves in this current situation?
Well, I think the best way to protect yourself in any situation is education and having a better understanding of how that system works. For anyone with open, that have loans from these banks, they weren't really the ones taking it on the chin, right? Because that debt will stay there. You're still gonna. It's funny. Someone's like, oh, this bank crashed and I owe them money. Now I'm debt free, and it's like, no, there's when Two Fingers Tony goes down, there's a guy next to him coming up to buy that book of business, and that's the way it goes. But the people that obviously where you create that issue are the people who have stock in some of those banks that lost a lot of value. But I think that you want to, as an investor, you want to make sure that you're well aware of the terms. And I think that something that can catch people off guard is, depending on what type of lending you're dealing with, you might see balloon payments. There might be other types of parameters or set boundaries on the type of loan that you've taken out that you normally haven't thought about. Or let's just say this, you haven't thought about it for a while because it hasn't been a concern, and now that's something you have to watch out for. I have on the residential side with people in that space, I have clients who had adjustable rate mortgages on their homes because they were their primary residence. They converted them to their investment property, which is a great move. And at the time, their interest rates were so low, there was no one wanted to refinance out of it, right? But then set it, forget it, don't think about it. Rates go up, your rate adjusts to the maximum adjustment amount, and now all of a sudden your interest rate is much higher than it would have been. So being aware of what's the worst case scenario in anything, call it hope for the best, but plan for the worst, and that's going to help protect you at least. But one thing we did see through all this, again, it's not those people who had their money in those deposits that were, with the government stepping in on this. Those people have been protected above that FDIC insured amount. So again, it's the stockholders that took hit on this. So, but again, to stay in line with the question, protect yourself through education, know your terms, and what is the worst thing that could happen, and just assume that could happen.
Thank you for that, man. I think understanding the terms, making sure you understand some of those, maybe due on sales clauses and things like that are in your agreement, that allows you to stay informed and kind of have those conversations preemptively to make sure you're doing everything you can to stay in control of your loan. Talk to us a little bit more about kind of where you are, right? Tell me about guaranteed rate. I know you guys work with a lot of investors, particularly in that 2 to 4 unit space. But tell me about guaranteed rate and some of the benefits that you all have when it comes to working with investors.
So I think one of the benefits that we have in a situation like this is that we do, work with a large amount of investors, right? Over 70 go to just out of the gate, 70 different investors that we can work with. So where that protects us is that when there's a liquidity concern, maybe some of the lines where you get your money from could dry up, right? But we have, a very strong supply, let's just say. And outside of that, where we're able to place our loans in the secondary market, we have, a very large portion of players out there that buy mortgages back from us when we need to stay liquid. So through all of this in that residential space, we're in a really good position. Guaranteed Rate as a company is very strong. I mean, we're debt free. We've done well. Victor Tardelli has built an amazing company and he's a great leader, and he looks forward. And we've taken steps that protect us against these types of movement because, again, hope for the best, plan for the worst, right? You don't want to be in a position where you're not liquid and you can't lend. And this is not the first time that the mortgage industry has seen, well, let's just say had concerns, right? So we're doing really, really well. And of course, because we're in that residential space, I mean, you see the little smile on my face. I mean, it's not to smile against any of the hardship that anyone will endure through any of this. It's a smile because as we watch interest rates move and we see business move up, it keeps us keeps us busy. I mentioned earlier, just to give you a quick idea of what I was alluding to, and I said how that this type of situation is good for the multi-unit space. Well, it was back in the crash in 2006 to 2008 when we saw obviously big issues that we were put into a position where there were loan products that came out of it that were focused on helping affordable housing. Well, we were able to benefit on that. This was primarily one loan, the Home Possible loan, which was allowed investors to put 5% down using conventional money and to receive much better terms. Right, you've got fixed money at a cheap rate with a low investment with leveraging your cash. Well, at that time we came out of that and they removed income restrictions, so you could have investors who are doing very well use these terms, whereas they're originally designed to help more people that are in a median income. That's changed in several years now that we've been in a position where they re-implemented those uh, limits on your income. Now, I'm not saying that it's going to happen, but it wouldn't be unheard of that in the push to look at affordable housing. Just keep in mind if someone buys a property and they're going to live in the unit and rent the other units out, that's good for the community. The community. So in an effort to do that, maybe we'll see those loans start to come back. So I'm hopeful.
I love it, man. Well, listen, I think it's great to understand like where the company is, and again, this conversation on SVB Bank has made everybody think more about kind of their own lender and their current loan situation. You talked about being a debt-free company. That's really important to understand. Now we know that hey, when it comes to some of the financial challenges that many people are going through right now, this is not one of those things that will impact a company like Guaranteed Rate. So, really great tips and insights for us to understand who our lender is, what are they looking for, and how can they help us achieve our own financial goals. Sam, we started by talking about the Midwest Summit. You all have been great partners of our event from the very beginning. Just explain from your perspective, why do you guys get excited about the Midwest Summit, and why do you look forward to the partnership?
I'm I'm a geek for education, right? It's just a it's and that's why I love the partnerships. John, you're an amazing individual at what you do. You strive for excellence. Your execution is on point. Bree Schmidt is by far one of the smartest people I know in this industry when it comes to this focus. And I love being involved with people who actually take the time to understand, educate themselves, and then continue that education to figure out how to adjust because things are always changing. And you guys are spot on point. And what's great about this summit and what's coming, not to make this sound like a commercial because I'm really not. I truly believe this. You're bringing that education to people. You're bringing this awareness. You're putting people in a room with otherwise, people that they're not able to sit down and have these types of conversations and understanding with, and that's tremendous. And I know obviously we've got to buy tickets. We're coming to the summit. I think it's a great value for what you're giving, but it's just amazing at how many resources we have out there now that are worth so much more. I mean, go back 30 years when people paid how much for college educations because that was your only choice. And now just look at what we have in front of us and ways that are not only teaching us about history or different things like you learn in school, but actually teaching you how to make money, right? Because I went to college and I learned a lot, but they didn't teach me how to make money. So I don't know, man. Education. You hear me say it. You've heard me say it before. It's my thing.
Absolutely. Well, listen, we definitely look forward to catching up with you. We're excited about the event. And as you mentioned, me and my partner, Bree Schmidt, we're excited to bring this event on, and it's going to be a great time. Hey, I want to thank Sam again for a great conversation and what's going on in the current lending environment. Great to hear how Guaranteed Rate is positioning themselves to still be there for real estate investors and kind of some of the things that they provide from that standpoint. I want to build on the conversation just a little bit because at the time that we did that recording, Silicon Valley Bank was really the only bank or one of only the few banks that has been impacted. And we've seen now that this has impacted First Republic and some other banks as well. And we want to talk a little bit more about how this may impact you more broadly as a real estate investor. And particularly for those apartment investors like myself, one of the things we have to be wary of, or at least keep our eye on, is that some of the smaller banks, and by smaller, I mean kind of the regional, the mid-sized banks, the ones who are typically loaning on these commercial real estate and apartment investing deals, they may not be as willing to invest or to loan on as many deals as they would have previously. So we can expect some things to tighten up. As a matter of fact, there's an article based on an interview with the NAR, the National Association of Realtors. Their chief economist, Lawrence Young, did an interview, and he talked about some of the things that they're anticipating moving forward. And one of the key things is, as we look at it, we look at where valuations are. This is basically appraisals. Well, if you look at appraisals from January 2023 to January 2022, appraisal value is down 16%. So some of these properties are not being as appraised as high as they were last year. The second thing, of course, is interest rates continue to go up and are higher than they were last year at the same time. And then the third thing here is that some banks simply will not be either in a position to lend, or they may just see it as more risky to lend on certain types of properties. So there may be less options as far as lending is concerned at this point. You put all that together, and basically you see a little bit of a tightening when it comes to your lending options and the valuations that you may get. So LTVs may be higher, especially if you're looking for a refinance. It may not be quite the terms you could have gotten a year and a half ago. So that's something to keep an eye on, as you look to navigate this environment. It's not to mean you can't find deals. It's not to mean that you can't refinance or anything like that. But it's always good to be aware of, where the puck is going, right? To use that hockey analogy, just helpful to understand what you should be on the lookout for and how you can get in front of some of that based on your projects, your properties, anything that you are looking to refinance, and just understanding, your lenders and relationships. I think the key takeaway for me, though, going back to our conversation with Sam, is it's a great time to have a good relationship with your bank, right? Who's your lender? You want to understand what's going on with them. You want to understand what they're looking for. And how do you make sure that you are well positioned within that bank so that if you need some flexibility, if you need to refinance, if you need to make any adjustments, you have that relationship. So it's a great time to talk to your lender. Make sure you build on that relationship, make sure they know who you are, and make sure you are clear with what their expectations are so you can navigate whatever situation you're facing accordingly. Thanks again for checking out this episode. I want to thank Sam Sharp for being a great guest. And for you, if you haven't already, make sure you hit that subscribe button, and also make sure you leave us that rating and review. It definitely helps us to connect with more listeners, and also gives us great feedback so we can make the show work harder for your investing goals. Till next time, take care.